Hello, this is Jim Lucy, Content Director for Electrical Wholesaling and Electrical Marketing. Over the next 20 minutes or so, we're going to give you an update on the electrical outlook for the rest of 2019 and 2020. It's a tricky market out there. We're going to help guide you through it. Very mixed bag of economic indicators out there right now. Some segments of the non-residential construction market are showing growth, and others, particularly in the industrial sector, are showing some signs of a slowdown. We've seen quite a few concerns out there over tariffs and their impact on capital spending, both with end user customers and amongst some of the manufacturers in the electrical community. While the overall non-residential market is starting to show some signs of slowing down, some local markets will outperform the nation by a wide margin. And as we said in the first quarter of 2019 in our previous presentation, the old saying, all business is local, will definitely ring particularly true in 2019. You can look for many of the Sunbelt markets that have led the nation over the past few years to continue to outpace the pack. The housing market nationally is fairly soft, but in some local markets, as you'll see later on, it's doing quite well. Areas with high population growth, vacation areas, and also areas where retirement communities doing very well. We are seeing some signs of a rebound for next year. Despite the overall slowing we're seeing in some of the data, there's some good news in the product pipeline right now. We could definitely continue to feature some pockets of growth in data centers, light rail, mixed-use projects, what they call the work, live, play developments in both downtown areas and in the suburbs. We're also seeing some signs of pickup in educational construction, with bond issues in some local markets supporting construction of the K through 12 niche in particular. Also, the enrollment trends at college and university are requiring more capacity, so that's good news as well. The other market segment that we're seeing looking pretty good right now is in the utility market, and we heard quite a bit in the most recent second quarter 2019 earning reports, with several publicly held manufacturers, distributors, and contractors calling out this segment as outperforming the rest of the non-residential market. Electrical distributors are still optimistic. Last time we checked in with them about 2019. When we surveyed them back in April and May for our top 200 survey, they concurred with the 6.1 increase that we had previously forecast in our 2019 Electrical Wholesaling Market Planning Guide. In that market planning guide, we called out the South Atlantic region with the highest forecast at 7.6%, and the lowest, the East-South Central, at 5.2%. The East-South Central includes Kentucky, Alabama, and Mississippi. One of the more bullish indicators out there right now is electrical contractor employment. Certainly an important market for our audience here, as electrical business with electrical contractors can easily account for 50% of the total market. The good news is that the employment has spent 15 of the last 16 months topping the historically high average of 900,000 employees. I can tell you that over the past couple of years, when we would see a number for the national average at over 800,000, we considered that pretty good, and it's been sticking high above the 900,000 level, which is good. In the second chart on the bottom there, you can see the difference between the 3-month moving average and the 12-month moving average. We take those, we blend those averages to monthly averages so that we smooth out the ups and downs that you see in this type of employment data. The thing that's good to look at here is that the trend line, the 3-month moving average, usually leads the 12-month moving average by about 4, sometimes 5 months. And as you can see right now, the blue, the 3-month average is been pretty level since the beginning of the year. So that's good news. One of the reasons that we track this employment so closely, many of you who are familiar with our market planning guide and use any of our sales per employee indicator forecast tools to come up with an estimate for market size, know that each employee represents 66,313 in buying power. And that's more than 50% of total industry sales. So still some good news showing up in the data for electrical contractor employment. News not so good on another indicator, good monthly indicator that we track from the National Electrical Manufacturers Association, or NEMA. Their Electrical Industry Business Conditions Index is a monthly survey of NEMA members, and we've seen some definite slippage in the EBCI, as we call it. over the past couple of months after a very strong run where it was well into growth territory. It is definitely showing it slipped below the 50% mark, as you can see over the last couple of months. One thing that keeps coming up in the monthly report are the tariffs are a major concern for EBCI respondents. Any mark over 50 indicates growth. We normally do report on this for the EBCI in both electrical marketing and in our monthly issue of electrical wholesaling, if you'd like to track this in any of our publications or websites. As I mentioned, the one area looking into some of the project work and market sectors, downtown redevelopment are still quite hot. Still quite a bit going on here. This particular photo is one I took while visiting San Diego earlier this year, and there's quite any of you have seen some of the work down there around the Gaslight District and along the port. Is quite a bit of work going on down there for sure. One of the more negative indicators that we're starting to see is something from the American Institute of Architects, which puts out several really good tools that I urge you to monitor on a regular basis. The ABI, as it's called, or the Architectural Billings Index, is a monthly survey of members of the AIA architects. And they asked them what they're seeing as far as billings, design contracts, and project inquiries. These are all leading indicators because it's typically 9 to 12 months before you see the billing. After the billings is when you'll see construction start. And as you can see in the chart there, they're starting to see some dips in initial inquiries. The billings are definitely under the growth mark there of 50%, and design contracts too are hovering right around the contraction level there too. So a couple things there in the Billings Index here. This is a stat that we report on regularly in electric marketing, also in the electrical wholesaling when we can get it in the issue depending on deadlines. It's a good source of information. It's available to all at aia.org. One of the other good tools that the AIA puts out is their consensus construction forecast. And they take basically they come up with a forecast from about 8 or 9 construction economists, and some very well-known companies, including Dodge Data and Analytics, IHS Economics, Moody's Economy.com, the Construct Connect, Associated Building Contractors, and Wells Fargo. They interview those folks and to see what they're coming up with. As you can see, for this year, they're predicting a 3.8% total non-residential, slipping down to 2.4% in 2020. One of the bigger declines they see between this year and next year is in the total industrial total, where they're seeing it slip from 6.4% to 3.3%. So as you look at these numbers here, you can definitely see some slippage in what they're looking at for market conditions, but they have a much more in-depth write-up on this on their website at aia.org. There's a fellow by the name of Kermit Baker, who is their lead economist at AIA. He speaks at a lot of the different construction forecast meetings. Very good, and he'll give you some more color and insight into what they're seeing in the market there. He's definitely overall, seeing a slowdown. Certainly nothing catastrophic, nothing along the lines of what we saw in the recession back in 2008, but definitely something that you may want to take a look at, and particularly see if the national trends, what your local market is reflecting compared to those national trends. Product that's put out by the folks at Dodge Data Analytics at construction.com is what they call the Momentum Index, and it's another study where they're trying to give you an idea of a leading economic indicator. As I have here in the slide, the Momentum Index is a monthly measure, the first or initial report for non-residential building projects and planning, which have been shown to lead construction spending for non-resi buildings by up to a full year. You get a sense there, looking at the right-hand side of the bottom chart, that it is basically is not too bad right now, but there has been a bit of a decline year over year, when they hit a high in 2018, starting to temper down in 19 a bit. They called out, Dodge in their most recent report for June, called out the institutional building segment as the healthiest of what's going on right there. That institutional segment includes the educational and healthcare. Dodge also puts out one of the their total their construction forecast annually. That's a event that takes place usually at the end of October, beginning of November. If any of you have the chance to get out to it and enjoy this type of market data, I would highly recommend it. I attend it every year. But you can get a sense of the overall trend line here, going back over the past couple. You can see that 2000, they're expecting 2019 to drop a little slightly from 2000, the peak activity in 2018. And this was a forecast, as I mentioned, that was put out in November, and their more recent data pretty well mirrors what they have seen, what they had forecast back then. One of the major reasons they did forecast a drop is that they were seeing single family to go flat, multifamily to go down, and those are two pretty good chunks of the total housing market there. And as we mentioned, they saw some growth in the institutional spending, which including the educational and healthcare. As you look and break down the overall non-construction market, we do that we have a good database of projects by electrical marketing. We have collected over the past 2 years of over 1,000 projects of over over 100 million in total contract value. Electrical is about 10% of the total contract as a real rough rule of thumb. But as we break down and sort and slice and dice those projects, the one type of project that keeps coming up is the healthiest, I guess you could say, or most numerous, are certainly the data centers. The list, what we're showing here, are just a list of some of the more recent ones that have broke ground over the past couple months in 2019. As you can imagine, many of these data center projects are being built by companies like Microsoft, Google, Facebook, Apple. There's a couple of little hot spots in areas of the country. Particularly well known for data center activity are the western suburbs of Washington, D.C., out into Loudoun County, a little bit into Fairfax County too, I believe. A lot of activity there. There's definitely some activity out in Oregon. The Prineville area has a couple of data centers for Apple, and I believe Facebook as well. And also in the Omaha, Nebraska, Omaha and Council Bluffs, Iowa, right along the Missouri River there, has some really large scale projects that you can see right along I-29 and some different parts of Iowa. Google, I believe, has a big center there, and there's quite a bit of activity going on there. Many of these are sizable projects, $500 million to $1 billion, and certainly any of you that have done any work with data centers know that they're absolutely loaded with all sorts of electrical work. So this, as far as anything I have read, showing no sign of slowing down. Some of the other large project types that we have included in our electrical marketing project database that we've seen a lot of activity on along the Gulf Coast, petrochemical plants and LNG or liquid natural gas export terminals along the Louisiana-Texas Gulf Coast. These are multi-billion-dollar types of projects. The export terminals in particular are starting to come on. There's a very long gestation period, I guess you could say, as they take quite a bit of time to get approval, various environmental approvals. But when they come online, they're multi-billion-dollar projects for sure. Also seeing continue a lot of airport activity, and many of these airport projects, when they do come online, $1 billion and up. So a lot of stuff going on there. A lot of light rail type of things, quite very active. I know Minnesota's got some things going on there. There's Boston's got the Green Line being worked on. A lot of work there. Other large projects, we see a lot of natural gas power plant additions. Starting to see, you'll see wind project, large wind farms are particularly big. One thing that we're just starting to take a look at now too, that we just announced over the past month, was a very large scale wind project off the coast of Long Island. New York it's got basically given the final blessing from the state level, and it is going to be a very, very large project. It will be the biggest project along the East Coast. There's a couple of things that you do have a small offshore wind project in just off the coast of Rhode Island, down and right around Martha's Vineyard. There's another one out there, I believe, that just recently has been put on hold for now. But if this thing goes through that they're talking about off the coast of Long Island, it is going to be a large wind project that'll rival many of the projects that you see in Europe, which right now is light years ahead of the U.S. as far as offshore wind. So lots of wire and cable, as you can imagine, lots of work for local construction workers there. That's going to be very interesting to check out. One of the other indicators that we like to check on a local level are office vacancy rates, and the folks from Cushman Wakefield are nice enough to publish a fair amount of information for free on about twice a year, I believe the vacancy rates come out there. Through the beginning of this year, Q1 2019, U.S. vacancy rate overall, 13.1%, as you can see in the slide there. And I just put together a couple of the markets that were below 10%, which is usually to my eye at least, when you start seeing markets with less than 10%, you know there's going to be a very good market for some office construction there. Some of the larger ones that are under that 10% number include Boston, coming in at 10%, San Jose, a couple of different segments. They actually break down New York into several different types between Midtown South, the Wall Street area, also about the 9% rate there. Overall, of the large markets there, San Francisco comes in at 5.8%, and that is one of the lowest of the larger markets. Cleveland actually pretty good at 6.7. Seattle also doing pretty well there. So this is good information here. If you want to get more specifics on it, I urge you to check out Cushman and Wakefield, or drop me a line, and I'll be glad to get you some of the background information here that I've collected. They have some different other data on office vacancy rates as far as absorption and things that you may find to be of interest. And I've got a PDF download if that could be if that's of interest. My email is jim.lucy@informa.com. Certainly the flip side of often-see vacancy rates, so that when you get to the markets that are awfully high, and when you start seeing things in the upper teen percent vacancy rates, and even over 20% are some of the really, really high markets there. We've got two suburban markets right now at the top of the list, Fairfield County in Connecticut, and then its neighboring Westchester County, also at 23% for Westchester, over 26% Fairfield. Houston looking at in a 20% up, 20% vacancy rate, and Dallas 19% vacancy rate. So those are some of the overall. Of course, it's kind of interesting when you look at Dallas and Houston. Despite the fact of the high vacancy rate, there's still an awful lot of large projects that we see in the pipeline for both of those areas. There's just so much building going on in Texas overall, and in Dallas and Houston specifically. So you can't get too wigged out about some of the numbers here, but it is some supporting information. You know, when you're trying to construct a market profile, you should take into account vacancy rates if you can. You know, as you mentioned a little bit earlier, it's been a fairly slow year for single-family housing. 2000, according to the National Association of Home Builders, they're expecting 2020 to be a bit better. This is a slide from their forecast, so you kind of get a general sense of the number of housing starts, what they're expecting for each year. You can see where we're at 2019, dipping down a little bit on single family, but you see some growth coming up in 2020, 2021. They're calling for a decline in 2019 of 1% in housing single family, and for 2%, they're seeing a 2% growth actually for multifamily. A lot of talk out there about how hard it is for home builders and certainly many other tradesmen to get good employees, and that's actually been holding back some of the growth there. There's also certainly some concerns out there in the number of first-time home buyers out there. You know, the demographics being such, this should be a very active time with the amount of folks that are in that 30-ish type of age bracket that might be looking at buying their first homes, but the pricing levels in many cases are just holding them back from being able to make that investment. So that'll be something that you'll continue to hear a lot of information about. As anything, as we mentioned, all business is local. There's some very hot housing markets out there. We track the building permits that come out on a monthly basis to kind of get a sense of which markets locally are doing the best. As we mentioned, the single family building permits are running a bit behind the last by about 4%, but there's quite a few markets in Florida that are actually in the top 10 that are doing quite well, and have several are each running at more than a couple hundred building permits better than last year. Those in the top 10 there, I believe there's 5 markets in Florida that are included there, including Lakeland, Winter Haven, Miami, Fort Lauderdale, West Palm Beach, the Villages, which is a humongous retirement community, and Port St. Lucie. So you can also, this slide here also illustrates some of the other areas that we see a lot of a lot of growth in. And those are certainly the vacation or retirement areas. You can see like Hilton Head down there for sure. Boise's become a very popular vacation area there for Boise, Idaho. So, and there's some other markets in this particular slide that you don't see pop up there too often, like a Tulsa or a Clarkville, but every markets can, and Hagerstown too kind of popped out that I had not seen as much. You don't see that as much, but also right now, at least through May year to date, looking pretty good on the building permits. As we mentioned before, the enrollment numbers for both K-12 and college and university are definitely reasonably strong. This will give you kind of a forecast looking out. You can see the numbers are basically looking pretty steady going out for the next 5, 6, 7 years. So no reason that there won't be demand for increasing amount of construction there. Certainly bond issues, as we mentioned several times on a local level, are the things that really fuel a lot of the growth at K through 12. University spending continues to be strong as far as we can tell, continue to be strong. A lot of projects in the pipeline there. So that's definitely a very active market. Those, as we all know, these facilities, schools, and universities loaded with electrical equipment, anything from basic power to the energy efficient lighting to security, audio visual, like quite a bit going on. Quite a rich opportunity here for the electrical market. As we mentioned, we're starting to see some very definite signs of a slowdown in the industrial market, and people are kind of watching this closely to see if this is how deep this might go. Prefacing everything, by saying certainly the tariffs are the biggest concern for sure, and it's reflecting in a lot of our data. You hear a lot about the Purchasing Managers Index. You see that in the general business press. It's a monthly survey by the Institute for Supply Management. They survey industrial purchasing managers, and they look at what, just to get a sense from them what they see the purchasing environment is. You can see it's in their index where anything over 50 is showing growth, but as you can see, there's been some very definite slippage over the past couple of months here. We're still just about over 50, the last I've seen, but you can kind of get a sense of where, that it is a bit of a declining market. Tariffs definitely came as a big concern. There were some concerns overall in the higher costs for base components for raw materials. Another indicator that you see out in the general business press a fair amount that is definitely it has its impact on our electrical market as well is the spending, capital goods spending, investment in plants and such. And specifically, the number to look at is the non-defense capital goods for new orders, excluding aircraft. Right now, the business for this is still relatively good. It's a big macro indicator, so it may cover some markets that you're not maybe looking as directly on. It does, however, have a big direct impact on new and plant office construction and renovation. So this is another stat that we look at the 3-month indicator compared to the 12 months just to see if the 3-month is reflecting any change. Very often, like I say, the 3-month moving average will be a couple months ahead of the 12 months. So the blue line below there, you can see over through the second quarter is actually increasing and just about leveling off right now. So we'll keep a close eye on that number there as well. Another indicator, as we measure the electrical contractor employment, so we can come up with our sales per employee figures, we do the same with industrial. And it's actually it's leveled off a little bit, but as you can see over the past couple of years, it has been increasing. The growth track is actually looking pretty good. It's the same thing as we mentioned before about the 3-month being a bit ahead of the 12-month by, in this case, by about 4 months. Also, we mentioned that we keep a close eye on this because we do use that market planning guide sales per employee calculator just to get an idea what the total, what a customer's volume could, a customer's sales potential could be. And the most recent electrical wholesaling market planning guide data shows that each employee in an MRO account represents $789 in sales. It's $825 in sales for an OEM account, and $108 in sales for a factory automation account. So it's definitely an important number there. You can see that it had dropped slightly through March, and it looks like to be leveling off most recently. So another good number to keep an eye on. Another one that we look at in the industrial markets, which isn't looking too terrible. going through the capacity utilization figures, basically looking at what they how much of a plant is being used. The rule of thumb is that anything over 80% is when they start using start looking to build a refurbish a plant. And we haven't seen that number at 80% since before the recession, but we're sitting around about 77, 78 right now. So we're not in bad shape. It's declined a little bit. We'll just see what where this goes over the next couple months. But this isn't a real. This is maybe just about an amber light, not a red light. So just kind of cautionary, but nothing too dramatic just yet as far as an indicator. One that we do look at over the past couple of years, we've been kind of factoring this into our forecast. So we like to look at the railroad freight, which is provided by the American Association of Railroads. They actually provide weekly readouts on the amount of freight by the carload and by the carload and the different types of products that are being shipped. You figure anything that is being produced at factories very often is carried by rail, so it's a useful gauge of broader economic activity. Through July, the freight traffic is down 3.2%, which isn't terrible, but it is still. We're hopefully it doesn't go down any further than that. Of the different products that they look at here, is petroleum products are up the most right now at 21.4%. Certainly, oil prices are always in the news. You can see where it's been kind of as usual, kind of a wild ride over the past year. We're up around 50 something a barrel at the time of this broadcast recording. We were as high as about 70 last year. Took a dramatic drop at the end of last year. Climbed up a bit, and so. Your guess is as good as mine where this is going, but you can definitely get a sense that we're much better pricing than it had been back in the 2017-2016 timeframe. We're at $50 a barrel. We'll see if we can. I think most people think we'll be able to maintain that and hit about 60 or so. That 50 to 60 range seems to be where we're going to be at for a bit. So we'll keep that one as well. As you look to some of the specific areas in the U.S. where the production where it's being produced, as you can see, the total U.S. it just kind of gives you a sense of just how much Texas continues to dominate this market. Through the end of July, the total rig count for the U.S. was 940 rotary rigs. Through the Baker Hughes provides this information out there. Texas had 454 of those rigs operating right now. However, the year-over-year rigs are down 101 down decline, and of that 101 decline, 70% of them are in Texas. So the biggest declines there are the Permian Basin and Eagle Ford, which are out in central Texas to west Texas. You hear a lot about Odessa and Midland and all that's been going on there, and that there's been a bit of a decline there. So we'll certainly watch this one closely as well, but did want to provide this type of information for you. That's kind of our brief overview that we have for the for our sales forecast right now. We'll be putting another one together before the end of the year once our new data comes in from the 2020 Market Planning Guide. Also, some of the other forecast information that we incorporate into our forecast, which include the Dodge, Construct Connect, some of the other data that comes in. I just wanted to do a brief sales pitch, if I could, for electrical marketing, because we provide quite a bit of information there on local market data, electrical sales potential estimates. We do product sales estimates for 17 product categories, and also we have that construction database that I had mentioned, as well as the other things we provide are some of the local market data, building permits, population, unemployment, if you're ever building out a local market forecast. It's something you could hope very helpful. It's all available right now at a crazy good rate of $99 per year promotional rate, and I think that that can't be beat for what we're providing there. That includes access to all this market data, and also you get the electrical marketing newsletter for news and some data cuts twice a month. To get some additional information on the subscribing, please do contact our audience marketing director, Sonia Trent. She'll help you out at soniatrent@informa.com, and you can see her phone number there as well. That's all I have for today. Thanks for listening to our presentation on key electrical market indicators for 2019-2020. This is Jim Lucy, Content Director for Electrical Marketing, Electrical Wholesaling, signing off, and we'll have another presentation ready for you in a couple of months. Thanks for listening, and have a good day.